Hello, and welcome back to Financial Education. My name is always Zach Collins, and today I thought I'd look into equity. I see a lot of people online saying, I have X amount of equity in my property, how can I maximize it? Firstly, before we do anything, I need to make sure you know what equity is and what it means. Essentially, what equity means is the ability to take on more debt. Before we get into that, for those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I'd love to get my license back one day. I chose to leave the industry as I couldn't stand the owner of the business, and spam was very heavy in sales. I've got no interest in sales. I mean, it's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax and compliance. Now, there are five main types of debt: credit card debt, personal loans, car loans, home mortgages, and investment loans. So, credit cards and personal loans don't need collateral. A car loan might need a car as collateral. A home mortgage needs a house, and investment loans could have a whole range of different collateral, normally a house or a stock portfolio. You can't have equity in a debt that doesn't require collateral. That's just debt. You could have equity in a car. What that means, for example, is the car's worth $40,000 and you've got a debt of 10 grand. If you sold the car and paid off the loan, you'll be left with $10,000 cash. That is the equity, 10K. With houses and investments, it's the exact same principle. Let's say you have a house worth 500K and a debt of 400K. This means you've got equity of $100,000. However, this is where people saying they want to make the most of equity comes in. For houses, most banks require you to have an LVR of 80% before they will give you that loan. You can get higher LVR mortgages, but these tend to be more expensive from an interest rate perspective, and you'll likely also need to pay LMI. What is LVR? So LVR stands for loan to value ratio. Basically, think of it how much of a property is debt. If it's 80% LVR, it means 80% of the value of the property is debt. In order to access equity, you essentially need to get your LVR down as low as possible, and you then bring it back up to 80%. That is generally required. For investment loans, to buy shares and stocks, banks normally keep the LVR much lower, normally around the 60 to 70% mark. If you're comparing a portfolio of the same dollar amount between shares and property, a larger proportion of the investment will be equity if you go the shares route versus property, as the banks will lend a higher percentage for property than they will shares. Let's say the prior example I use stays the same, except we're looking at 10 years into the future. The property is now worth $1 million, up from the 500K earlier. You paid the mortgage down from 400K to 300. This means if you sold the property and paid off the loan, you'd walk away with $700,000 cash. This doesn't assume any transaction costs. To keep it simple, we'll keep it 700K. While you have 700K of equity in the property, it doesn't mean you've got $700,000 of usable equity. The banks want you to keep an LVR of 80 or below. So 80% of 1 mil is 800K. This means on that property, the max loan you can have on that property is $800,000. You currently have a debt of 300. This means you could borrow a maximum of a further 500K, using that specific property as security for that loan. Okay, so now you've got the basics. That's not where it stops though. Before the banks even look at the assets you bring to the table, first, the banks will look at your income and your expenses. I highly recommend talking to a broker if you're in the market for a new home loan, as it can really help you have a big impact on how much you can borrow. However, as a general rule of thumb, you can borrow between 4 to 5 times your gross income. This is what worked before the pandemic, and it's fairly accurate now. If the RBA rates were to go over 5% or they increase the loan buff to 4%, the higher end estimate might be a bit too far of a stretch. However, a decent rule of thumb, assuming you've got no other debt, this means no car loans, no credit cards, no personal loans, also no HEX debt, nothing. You could borrow roughly 5 times your gross wage. Assuming you have a salary of 60K, this means you can borrow around 300K at the max, as long as that's your only debt. If you do have a credit card, personal loan, HEX debt, this then gets backed into your services and it reduces the amount the bank will lend you. Let's tie this back in with the property. As I said earlier, assuming you're on 60K, you can only borrow a max of $300,000. If this is the wage the person with the $1 million home is on, the most they can borrow, regardless of the value of the property, is 300K, which is the debt that they currently have. Theoretically, if they had a higher income, They could max out this usable equity of 500k, but given their income of 60k, the equity in the property cannot be touched. If this equity was going to be used to buy an investment property, the bank will factor in a portion of the expected rent in the serviceability calculators, so the person on 60k could borrow more. However, the rent and extra serviceability is probably not going to be enough to let them actually buy a property without putting in a decent amount of extra cash, which it almost defeats the purpose of it. Now, why would you want to access equity in a property? There can be many reasons. Maybe you don't have additional cash that you want to buy a new car or go on overseas holiday. These expenses you'd put on a credit card or personal loan or car loan. These types of debts actually tend to be higher than a mortgage. So if this mortgage is 6%, the car loan will be more like 8 to 9, personal loan 10 to 12, and a credit card 15 plus. So if you're going to go into debt either way, putting that expense on the mortgage is probably the cheaper option. The second main reason is people want to invest or buy a new main residence. The collateral for the loan does not determine whether the loan can be deductible or not. If you borrow against your main residence to buy an investment property or shares, that new loan could potentially be tax deductible. If you were to use the money to buy a new place of residence, the new loan won't be, but the old loan could be turned tax deductible. Do you need to use your accessible equity? No, and many people don't. Most people want to have their home paid off and be fully debt-free by the time they retire. If you keep borrowing against your equity, you'll never be debt-free. Now, hopefully I've been able to give you a better understanding of how equity works and what you can do with it. Get any more questions? Please feel free to drop a comment below and answer if I can. Thank you so much for watching, and I'll see you guys in the next one.